make the case for the defence. Tell us why pensions are not, this thing over here that we shouldn't worry about and forget about when they're a bit dull. Why are they so exciting? And advisors have got an important role in this, is encouraging people to start early.
Start early, little and often, but also try and treat it as almost like a bill payment. That £50 or £100, whatever it is that you can afford to put into that pension is really kind of going to benefit not only from potential growth in the market, but also the tax relief, as Steve mentioned.
Just put some context, put some numbers around tax relief. If you are lucky enough to be a higher rate taxpayer, you can have up to 45% tax relief.
Yeah.
If I were to say to anybody, I can give you an investment that will give you 45% in your first year, you'd think I'm a lunatic. This is how it is. It's such an attractive benefit. And I'm happy.
Hello everyone, and welcome back to another True Potential Do More With Your Money podcast. It's episode 114 today, and we're going to be answering the big question that's on everyone's lips, including yours, which is, how much should I take from my pension? It's a very important question, and we've got some important people to help answer it, so let's meet them. Let's start with Jenny Lang back in the studio today. Hiya, Jenny.
Hello.
Are you all right?
Yeah, I'm good, thank you. How are you?
I'm very well. Top of the world. Nice to see you. We've got Steve Hutton. Hello, Steve, are you okay?
Yeah, I'm good, thanks.
Yes, good. Nice to see you've dressed down today for us.
Yeah, and special effort. This is how a middle-aged man dresses down.
Just lose the tie.
Yeah, correct.
It's very good. It's excellent. And making his podcast debut today, we do like a debutant on the podcast. It's Tom Robertshaw. Hello, Tom.
Hiya, how are you doing?
Oh, I'm great. How are you?
Yeah, not too bad.
You know what happens, don't you?
I should have known about this, but
when it's the first one, you know what I'm going to ask. Do you know my question, don't you? It's your first time on the podcast. What else have you done for the first time this week?
I haven't actually done anything very interesting this week at all, but...
we'll be the judge of that.
I know. I fixed my first light switch for the first time in the bathroom, which took about 6 months to do. Right. I'm not much of a DIY man, to be honest. So
you fixed the light switch?
Yeah, light switch, not the bulb.
You didn't just change the bulb? No. I mean, that was a simple
No, light switch. It was a bit more technical.
You haven't had any light in your bathroom for...
No, I have. It has been working.
Right.
It just was a bit detached from the wall.
Or just a beard.
Yeah, maybe.
What's that?
Yeah, it's nothing much interesting for me this week, unfortunately. But
that's okay. Well, for more revelations like that, and also to find out what's happening in the markets, all you've got to do, by the way, is hit subscribe. Just flick that red button. Tom will come and change it for you if you want. Flicking switches, but just click the red button. Do subscribe to our channel, and you can get all the markets update and great revelations like Tom's light switch. So it's all good. Right. Before we get into the topic today, which is how much should I take from my pension, or even Steve's, what I want to know is, what is your favourite thing about a pension? Come on. I can tell it. I can tell, okay. Steve, you're such a pension, an authority on pensions. You love them. You think about nothing else. What is your favourite thing about?
Well, it's very kind of you, because at my age I am thinking a lot about my pension. So
right.
There you go. I'll tell you what the favourite thing about the pension is. It's tax relief, and it's the fact that you can actually get some money back from the government, which is really, unless you're a PPE provider, it's very unheard of in this day and age. But it's money for nothing. So that's my favourite thing.
Okay, bit of tax. Jenny, what's your favourite? By the way, this is a question that I think has never been asked on any podcast ever. I think we are breaking new ground here. Has anybody ever seen a podcast where they've said, what is your favourite thing about a pension? No. I've never seen it.
There's a lot of firsts going on today.
Absolutely, yes. Indeed.
Well, I think my favourite thing certainly for my age category, not Steve's, yes. Is that I can't access it. Ooh. So for me, being sometimes an impulse buyer, it's good to have it in a pot that I know I can't touch until I get to Steve's age group.
Is there anything else you're not allowed to touch?
No, just my pension.
Yes.
Yeah. So
I think the rebel in Jenny's coming out here. She needs like a rule to say you mustn't do something. Like I
think we should have other rules on this podcast, Peter.
Such as?
Yeah. Well, these kind of leading questions.
Yes.
Anything else you can't touch? Good answer.
Good answer.
She's not allowed to touch Tom.
Yeah, please don't.
We are maintaining social distancing, even though you don't have to. Tom, what is your? I mean, we should just say, by the way, you are a fully fledged, fully paid up, qualified financial advisor. You know everything there is to know about a pension.
Well, hopefully, anyway.
We hope so.
I mean, I suppose from my side of things, it's probably the drawdown options that you've got. So obviously, Steve sort of talked about the tax relief that you can get.
Yeah.
But if you can draw out your pension tax-free as well in different ways of doing it, so utilising your personal allowance with taxable income and then tax-free cash with the rest, that's how we normally sort of set up drawdown payments. You get that tax relief, and then when you withdraw from it, you can actually withdraw from it tax-free as well. So that's certainly an advantage, I think, especially using a financial advisor when you're from that side of things.
Yeah. I think my favourite one is that your employer pays in as well.
Yeah.
So, for once we all get some money out of Daniel Harrison. Which is not an easy thing to do, but on a pension you can.
Yeah.
I love that. So we'll talk today about how, the big question, which is how much should I take from my pension? But first of all, Tom, I'm going to stick with you. I'm going to put you under the spotlight here a little bit. Pensions do have a little bit of a bad reputation, or at least, maybe not a bad reputation, but they're seen as being a little bit, I don't know, dare I say, boring, a little bit of these things that we don't need to worry about until you get to, perhaps closer to that. Just playing back your words, I didn't.
You touched me as well.
I did. I'm allowed to, I'm not Jenny. Make the case for the defence. Tell us why pensions are not, this thing over here that we shouldn't worry about and forget about when they're a bit dull. Why are they so exciting?
I think, first of all, there's probably, especially for my generation, going to be a massive pension crisis in years to come. I mean, I know you've tackled on, sort of looked at that before, the tackling the savings gap.
Yeah.
I think a lot of people think, when they're my age or, Jenny's age, you think, what's the point? I'm just going to not sign up to the auto enrolment scheme and just forget about that for years to come. And, unfortunately, there's just not going to be good pensions in the future, really. We haven't got those final salary schemes that, Steve might have had in the past. But
we're only 5 minutes in. I'm sorry, Steve. I've just touched it again. I can't help myself.
I'll have my moment.
I'm sure you will. So from my side of things, it's really just little and often is the most important thing. I mean, you hear that all the time on this podcast, but just making contributions into your pension. If you're younger, maybe taking a little bit more risk as well. Obviously, looking at your risk tolerance questionnaire just to see what you'd come out as, but you've got a much longer time horizon there, to play with. Yeah. So you can afford to take on a little bit more risk. I mean, my pension, I've got it in the aggressive fund, and I'm not going to, alter that at all. I think it makes sense to have it in an aggressive fund because, I've got 35 years or so until I get to sort of pensionable age or state pension age. It'll probably keep going up by the time that I get to pensionable age. So, obviously for a lot of people they are boring, but, it's just about something where if you get yourself and set yourself up on the right footing, you don't really have to think about them until you get to pensionable age, really.
And if we go back to 2015, Steve, pension freedoms, I mean, they were meant to make pensions a bit more funky. You can do a bit more stuff with them now, can't you? They're not. I think boring is probably not the right word. We shouldn't think of them as being boring. We should think of them as being exciting because it's how you're going to finance your future, and you do have more options now, don't you?
Well, let's just cast our minds back a little bit, and you're right to sort of think that. To young people, pensions seem really boring. Tying your money up seems really boring, I suspect, because, you're young, you've got plenty of time, you want to have some fun, and you want to spend your money. There was no different in my day, let's not kid ourselves. When I was your age, pensions were really boring for me too, but there was a subtle difference. We had a bigger state, a more nanny state, if you like, so the responsibility was on your employer or the government to provide a pension. So hence, people of my generation are getting to a stage where you've generally got some pension savings. Yeah. You were really right, Tom, to pick up on the fact that people at your generation won't have this. So, one of the benefits of sort of having smaller government has been that we have more freedom and more choice. But one of the downsides is you've got to realise that you've got to make provision for your retirement, and that's
taking responsibility, isn't it? Really, in the
correct. And it's our responsibility as a financial advice firm to make sure that we get that message across as much as we can. We get the message out that you do need to take individual responsibility and start saving. And it is boring, it can be. But 2015 pension freedoms, again, it pushed the onus back onto the individual to sort of you can have a little bit more freedom with your pot. But you've got to build your own pot up now. We're not going to help you too much. So it's been to be fair, the last 20 years have been a sort of series of changes going on through pension legislation, which are really confusing as well. So it's boring. You're tying your money up, and it's something that probably seems really confusing. So we're going to talk about it today, I'm sure, but it's a desire for people to come and get some advice and talk to people like Tom and Jenny about how they can.
And the advice angle is really important, isn't it? Because people, Jenny, now who have built up, sizable pension pots, you don't just suddenly have a lot of money. They will be people who I assume through their advisor maybe 20, 30 years ago started putting £50, £100 a month away, but they did it early. They did it at a time where they had, as Tom said before, many, many years for that to grow, and now they've got the pot. So the key is, and advisors have got an important role in this, is encouraging people to start early.
Yeah,
and,
start early, little and often, but also try and treat it as almost like a bill payment. You know, that £50 or £100, whatever it is that you can afford to put into that pension is really kind of going to benefit not only from potential growth in the market, but also the tax relief, as Steve mentioned. So, you know, and I think that's why Impulse Save is such a good feature, because if then, you know, you do have that little bit more, say, you know, you're paying £50 a month, that's kind of what you can afford. But if you get a good bonus, Impulse Save that in, you know, it's extra that you didn't have. And yeah, I think the technology within the client site really allows you to kind of look at the goal that you want to set and work out how you can get there.
Yeah, I do think just in general, you know, you talk to your friends, you talk to, you know, your sort of colleagues as well, and there is certainly I think a misunderstanding out there of just how much people are going to need once you get into your mid 60s or your late 60s to see you through. You know, if you're thinking about 20, 25 years worth, and you just think, well, how much does the average person want to sort of have as an income effectively from pension to live comfortably, multiplying that by 20, 25 years, and there you go. You're suddenly talking about reasonably big, well, very big pots of money, aren't you? So,
certainly. I mean, if you look at like the 4% rule, for instance, you'd have to have for £20,000, you'd have to have a £500,000 pot. So it's a lot of money really that you need in there.
And the sooner you start and you get the markets working for you and the compound growth,
absolutely,
that over say 30, 40 years is what makes that very achievable.
Yeah, I mean, like the compound interest is certainly a big thing, especially in the later years of your retirement as well, when you've got a sizable pot and it keeps growing and growing and growing. I mean, I've actually did some calculations myself on putting the amount of pension contributions that I'm making and seeing what sort of size pot that I got, and I was quite surprised by it, to be honest, because I've got time on my hands, which is the key thing here. But you know, the later you start, the harder and harder obviously that becomes, because it's that compound interest in the last few, you know, 10 years of your, you know, leading up to that retirement that really gets you the good growth in the pension pot.
You also can't really rely on the fact that there might be a state pension, because, you know, for us, you know, even if there is one by that point, it might be, you know, a ridiculous.
You just don't know, do you?
And pensionable age keeps going up, you know, it's going to rise to 57 soon. We don't know what that might be at our age when we get to sort of pensionable age, whatever that might be. It might be 67 by the time I get there.
I think it's going to be 66 for me, to be fair. And as you've all pointed out, I'm very old, but I'm not there yet.
And you mentioned the technology before Impulse Save, but the other thing that's great about the app is that you can see your goal. You can see where you are along the way. And are you on track? And is it the kind of thing you can think, well, look, I'm on track, I'm ahead of my goal, or I'm on my goal, so I can relax a bit. And if you are just dipping beneath that, you mentioned Impulse Save, so it's all there, isn't it? You know, it's gone are the days of where you've just got to rely on a statement once a year. You can check your account anytime. You can log in and see exactly where you are.
It's got live daily values, so you can kind of see what's happening, and maybe link it up to, you know, maybe what Paul and Jeff talk about in the morning market videos. But it's all there for you.
Another thing I'd like to add to that as well is, from a drawdown perspective, when clients come and ask me, you know, how much can I put into, you know, how much have I got enough at this point? You know, we've got really good technology from a drawdown perspective as well for TP1 goal, where we can look at effectively how much they've got in the pot, how much they need, what other guaranteed income sources are coming in, and we can build that in, and we, you know, provide advice for them, which is quite visual and quite good for the client to see as well.
People shouldn't be disheartened. We're talking a lot about you're going to have to build a decent sized pot to have a reasonable income. Don't be disheartened, because how much is enough? It's as much as you can save. So, you know, don't be put off and think, I'm not going to do anything because it's a futile task. You will be amazed, as Thomas said, how compound interest really starts to make your pot look attractive once you've got a few years under your belt. So start early, keep going, see it through the course, and I think treating it as a bill is a great idea. You know, get it. It is a bill you need to fund for your retirement, so get on with it.
And also that point that you made about bonuses as well, that's like a really good thing, because, you know, a lot of people are one sort of bonus paid now, so you can set up a direct debit for your monthly pay coming out as a bill, but then also using, you know, your bonus pay via Impulse Save is just a really good option for clients.
Well, look, I think we've done a good 10 minutes there on the case for why pensions are exciting and funky, Tom. I think we've turned it around. But let's get into the big question now then. So, and then the topic for today's podcast: how much should I take from my pension? A nice easy one for you, Steve. How much should you take from my pension?
Well, Tom's alluded to the fact that you've got a thing called a safe withdrawal rate.
Right.
And what do we mean by that? It's you don't want to be, you may have to deplete your pension pot, but you don't want to deplete it before you whilst you still need it. So, life expectancy, I mean, the pandemic may have changed this, but life expectancy is creeping up all the time. So you've got to take some advice, or consult a professional to sort of say, well, if my life expectancy is 83 or whatever as a male in the UK, I'm going to retire at 65, I've got to look and make my pension pot last that long. So you have a safe withdrawal rate, and we talk about 4%, 4 or 5%, I think. Also looking at what you expect the markets to produce for you, because don't forget, the longer you leave your money in your pension pot, even when you're in retirement, because you have an accumulation phase of your life, pre-retirement, where you're saving, you have a decumulation period of your life when you can no longer fund your pension from physical cash going in. But the markets, if it's still in them, hopefully will still be funding your pension, if you like. The market will still be hoping that your pension pot will be growing. So talk to an advisor, think of what your safe withdrawal rate is. That'll give you an indication as to what. Don't forget, everybody, though, if you don't, your pension pot should be the last pot of money you start to deplete when you're going into retirement, because it's outside of your estate. Tom might mention later about inheritance tax planning. It's the most tax efficient vehicle you have. So if you've got other savings, ISAs, whatever, use them first. Leave your pension pot in situ. It's still growing while it's in situ, while you're not tackling it, but equally it's outside of your estate for other tax reasons as well.
Just to allude on that sort of 4% rule as well, if you've got a state pension coming in, or maybe a defined benefit pension coming in, you can obviously take a little bit above that 4%. It's not that strict, and then you can drop it down once those other guaranteed income sources are coming in as well, which will certainly help. And I think people often see 4%, and it is, if you're in receipt of your state pension and other guaranteed sources, I wouldn't really go above that 4%, to be perfectly honest. But you can factor those in if you're going to be sort of retiring, before you start receiving those guaranteed income sources, and have a little bit of a slightly higher withdrawal.
And Steve, you mentioned taking what you need, but leaving the rest invested. Was that a change that pension premiums brought around, where you weren't changing into an annuity, you could now leave it invested? Was that one of the benefits of?
Certainly is. Unfortunately, a lot of providers still have those old products as well. We find a lot of the time, if you look at other providers on the market, you can't just take tax-free cash like you can with us. You've got to take your tax-free cash and then go into income drawdown, which is just, ridiculous really, since we've had pension freedoms. Good for us because, our products allow that sort of flexibility, but there is other, providers on the market that still don't offer that flexibility, unfortunately.
It's a really good point. Don't forget, I'm not a financial advisor. So it's all sort of self-interest, my knowledge on it. You've got to think of what an annuity is. If you are either compelled or you choose to buy an annuity with your pension pot, you are effectively doing a swap. You're swapping an amount of capital for a guaranteed income, which probably sounds quite attractive. But don't forget, annuity companies are not charities. They're not doing it. They're doing it to make a profit. They will run an annuity. And they'll base it on life expectancy, etc. You're best taking advice if you've got a significant pot, and if someone's trying to compel you to buy an annuity, make sure you're talking to someone who knows what they're talking about first, because once you've paid it, it's gone. Your cash pot has gone. You're getting an income, but your cash pot has gone, and that was a difference in.
Yeah, that's certainly the problem, is the death benefit side of things. If an annuity, you only get a 50% spousal death benefit, whereas obviously with a defined, with income drawdown, for instance, you can. Pass it on to your spouse, and obviously before 75, it's free of inheritance tax, and also free of any income tax when they withdraw from it if you were to die before 75. If it was after 75, then again passes to the spouse, free of any inheritance tax, but it might be taxable at their marginal rate of tax. So, certainly the death benefit side of things from our type of pensions.
Do you find, as an advisor, that people know about this? I mean,
no, they don't.
Really, there's a lot of unawareness of that.
Certainly, I think a lot of clients believe that once you die, that your pension dies with you, which is a shame, really, because it's just not the case. And that's why, certainly one of the factors that you alluded to, Steve, was inheritance tax planning. If you've got an inheritance tax issue, you want to be putting as much money into a pension as possible, really, because it's the only product on the market where it falls outside of your estate, but you can also access it quite easily. I mean, if you look at trusts, for instance, for inheritance tax planning, they fall outside of your estate after 7 years, but they're quite difficult to get the money out. If the settler of that trust wants to take some money out, whereas with a pension, you can get the money out whenever you need to, really. So it's a full flexibility and outside of your estate. It's a really good product from that side of things.
I think just on the point, and going kind of slightly off topic, but we're talking quite heavily about, the fact that it is such a good vehicle, the pension, for kind of inheritance tax planning, is make sure that certainly with our product you can update your expression of wish, which kind of confirms where you want your money to be paid to, or who you want to be the beneficiary of your pension. You can do that via the client site as well, so that's such an important thing to make sure you've got that updated.
Yeah, and Tom mentioned the tax-free lump sum of 25%.
Yeah.
You can do that, but there's no need to do that all in one go, is there? You don't need to take 20 as soon as you can. You can break that down into bits as well, can't you?
I think really the best thing at times is to take what you need. If you take out your full 25% just because you can, what are you going to do? Put it under a mattress if you don't need it? Put it in the bank, where you're losing the potential growth that you would be getting if it stays invested. So if you've got 100,000, you can take that 25% tax free. If you only need 10,000, just take 10,000. You can come back tomorrow and ask for another 5,000 if you need it.
That's a great point, because I think people feel, and this is harping back to before pension freedoms and when we used to have a state-run pension scheme and an employer-led pension scheme. People used to look forward to getting to retirement and taking their tax-free cash sum and then put it in the bank and get no return on it.
Yeah.
Bank returns, and it isn't back to an investment stroke sort of saver mentality. You're getting nothing in the bank at the minute. If you put your money into the bank, you will get no return.
Yeah.
So it's in the news all the time, I'm afraid, at the minute. Inflation 7 and a bit. No sign of it really dropping at the moment. So you're getting nothing and you're losing 7.5% per annum. Why would you do that? So Jenny has a great point. Why take your full tax-free cash to lose 7+% on it per annum?
I think one thing you said in the past, it's you guaranteed to lose money in real terms.
Yeah.
That's a guarantee in real terms, because inflation's so high and you're getting say 0.5 to maybe 1% if you're lucky at the moment. It is whereas with the stock market, obviously there is a potential for loss, obviously, but over the longer term, there should hopefully trend upwards, and it's about giving yourself the best chance of possible of beating inflation. When it's at 7% at the minute, that is quite high. Obviously, we'd hope that it'll drop down in the back end of this year, but it is quite high at the moment.
I mean, Jenny's point as well, you don't have to make that. That isn't a final decision. Come back, take what you need. If you need a little bit more, bring Jenny and a team up and they'll sort it out for you.
Yeah, and I think again the important thing as well is we're not talking about it takes months and months as part of the process. So where you're thinking, I don't want to have to go through this, it's such a painful process. You can do it all online via the technology. So if you do want to speak to a financial advisor, that's absolutely fine. But also if you need to request it yourself directly, you can do that via the technology, via your client site, and it takes around 9 working days from you requesting it to us kind of paying it out, as long as you've given us all the information that we need. But it's not a lengthy process, which I think some people think that it could be based on how complex pensions are.
And that technology is great, especially with tax-free cash, because with tax-free cash you know exactly how much you want to take, and there's no tax implications at all. So you don't necessarily need a financial advisor. I mean, you might do for sustainability side of things, but just for that tax-free cash withdrawal you might not need it. And that bit of technology there is brilliant for clients that they know, for instance, they might be like earning above the personal allowance, so a basic rate taxpayer, so therefore if you take tax-free cash it's not going to incur any sort of tax issues. So it's a really good tool to use, and it offers that flexibility like you said before.
And Jenny, what happens if you're in the accumulation phase that Steve talked about, and perhaps you've had various jobs over the years, you've had different employer pensions, so you might find yourself where you've got maybe 3 or 4 different pension pots, and you're thinking, well, actually that's 4 different statements or 4 different apps. I would like to put them into one place, say with True Potential. How easy is it for people to transfer those pensions across and just build one pot that they can just keep an eye on, rather than sporadically looking at several different things? Is it easy to do?
Again, so easy. Again, via your client site, there's a button on there which, if you haven't already added your external pension pot, say with other providers, onto your client site, you can do that and ultimately just transfer them to us and click the button to say, I want to go ahead and proceed, and we'll automatically go away and do that. But again, adding the policies to the client site isn't difficult. It's asking for the rough value, the policy number, the provider, and the fact that you want to transfer, and that's pretty much it. So again, it's a great tool, and it's so much easier to have them consolidated. So like you say, you're not going to 4 different providers, living by 4 different rules, going by 4 different processes. It's all in one place.
And we talked about the tech side of things and how you can see how your pension's doing. You can see the daily growth on that. You can see how you're doing against your goal. Are most providers in that kind of tech space, or a lot of them in the pension industry firms, are they still paper reliant? I mean, we talk about our technology here, and is everyone like that, or are we sort of at the cutting edge of that?
To be honest, that's probably one for Tom. You probably deal with more providers.
Yeah, I mean, to be honest, in terms of the providers, there's a few on the market that are digital, but the majority of them at the moment are not. And that's one of the things. I mean, I spoke to a client the other day, and I won't name the provider, obviously, but he was just saying, look, he's got stuff with us already. And he loves the platform. He can love how he can see exactly what the sort of fund manager partners are doing in terms of changing the weighting of the funds. And he's very analytical, so he loves seeing all of that, which he just doesn't. You don't get with many other providers, to be honest. That sort of technology. Yeah.
It is strange in this day and age that there are some providers out there still just popping a lengthy statement in the post that's probably most people would struggle to sort of understand a lot of it and then interpret and have to wait another year to get an update or again. Whereas why should everyone not be on?
It's remembering, on a daily basis, if you move address, to remember to call every provider and update your address depending on what information they need. So the fact that it's all online, you've not got to worry about, things like that.
It's that full holistic view that they get with us, isn't it? Yeah. I suppose it's a bit detrimental to us at times when, when the markets aren't doing as well, because they can see the performance, and when they are doing well, obviously it is good for us. Yeah. But with, a lot of clients, they originally would just get a paper statement once a year and they'd see if it's gone down or up. And it's with us, we are very much honest with the client of what they're getting, really.
And I think, but on that point around people being able to see ups and downs, and you've got to just trust people to understand that markets do go up, they do go down, but over the long term, they tend to trend upwards, and always have over whichever period you look at. If you look at over a long enough period, so if you like denying people access to their information, probably would not be something that we would support. You've got to trust people that they're building for their future. They're understanding that there are bumps in the road, but the road ultimately is what takes you to your destination.
I think the elephant in the room here is when we're talking about providers, we're talking about the old established life insurance companies, because they were generally the providers of people's pensions. And I think one of the scary things out there is that there's been so much consolidation in that market that many of them are even going by a different name now. So, you might get towards retirement and thinking you had a pension with X provider, and it's a completely different name now, so it confuses you. I mean, some of their branding confuses me. The fact that some of them said they've taken all the vowels out of their name, which was bizarre because they haven't. But anyway, I think their technology is historically not very good. They're big kind of beasts that are very cumbersome, and I think it is very difficult to deal with them. And I think using our technology and the efficiencies we've got helps you to sort of navigate a way through, because we do most, once you press the button, we will start doing that process for you and dealing with these big, mega companies.
I think one of the problems with these companies is they've got too many products, to be perfectly honest with you.
And not enough vowels.
They're not enough vowels, but they've got too many products, and it makes it difficult for their customer service teams to deal with it. And, in reality, you just want the best product on the market, which obviously for us in our case is a personal pension, really, and one that's, as flexible as possible. So that's what I find with a lot of providers. They've just got too many complicated products, and it makes it very difficult dealing with them, to be honest.
We've touched on, we've talked a lot around how much should I take from my pension, but just to kind of, as we begin to kind of wrap up a little bit, just wanted to Tom, for you to clarify, how much can I put into my pension? What are the rules around how much you can put in, and when do you stop doing that, or can you carry on forever putting pensions? What are the rules?
Well, it depends on what sort of contribution you're making. First of all, if you're making an employer contribution, then you sort of limited to 40,000, but you're not bound by the relevant earnings rule, which is a really sort of good thing. If you're a director of your business, I think we probably don't really talk about this enough, but if you're a company director, you can put money directly from your business into your pension, and like I said, you're not bound by the relevant earnings, so you can put 40,000 a year, or you can backdate that 3 years and put up to 160,000 in as well. And you also benefit from the fact that you don't pay any employer or employee national insurance, you don't pay any corporation tax, however, and you also don't pay any income tax on that contribution, but you don't get that tax relief at the other end because you're not paying for that income tax. And then obviously you've got personal contributions as well, which is for the majority of us who are employees. Effectively, personal contributions, you are bound by the lower of your relevant earnings, or 40,000 a year, but you can use carry forward relief. Now, personal pension contributions, I would always try and speak to a financial advisor, because you've got to take into account tax relief as well when thinking about how much you're putting in here. But you do, get the benefit of that tax relief, and also if you're a higher rate or an additional rate taxpayer, you can also, extend the tax bands on self-assessment, which gets you an extra 20 or 25% as well. So, huge tax advantages there of making those two different types of contribution, really.
And what are the rules when you start to take your pension in later life? Are you able to carry on contributing as well, or not?
Yeah, so you can keep on contributing, but personal contributions, obviously up to 75, you'll get that tax relief. After 75, you won't get the tax relief, but it's certainly advantageous to actually even still contribute, because if you've got an inheritance tax problem, I've actually dealt with a client this week who had an inheritance tax problem but is over 75, and because he's got an inheritance tax problem, it still made sense to put money into his pension pot, because yes, he's not going to get tax relief, but he's not going to get taxed at 40% on death. So in that instance, it made sense to still contribute into his pot.
Let's put some context, put some numbers around tax relief. If you are lucky enough to be a higher rate taxpayer, you can have up to 45% tax relief.
Yeah.
If I were to say to anybody, I can give you an investment that will give you 45% in your first year, you'd think I'm a lunatic. This is how it is. It's such an attractive benefit. And I'm harping back to, I think my point about what's the benefit was the best one, because I do. I'm sure it's not, but equally as good. However, you can have up to 45% tax relief.
Yeah.
And backdate, you can use unused relief from previous years. It's a no-brainer.
Yeah. I mean, if you think about inflation as well, 7% versus the potentially 45% that you might get from tax relief, I mean, that sort of does it a little bit, doesn't it? Doesn't make sense.
52 if
Just
your
a
money's in
little.
the bank.
Brilliant. Well, look, I think you've convinced me, and I'm sure everyone, that pensions are actually pretty cool. There's a lot of good stuff you can do with a pension, isn't there, Tom?
Pretty cool.
I can see why you love them. I'm thinking of that little emoji with the glasses on. Anyway. Right. Well, look, I think we'll wrap up now, because I think we've covered that one, and I think we've done it rather well. So thank you very much for all of your insight and what you love about pensions. I feel like I've got a lot of insight from you, Steve, today about what you love about a pension. It's
Always
great.
trying to educate you, Peter.
And keep on doing it. I'm like a sponge. I'll just absorb your knowledge, Stephen. There's lots of it. Right, Tom. This weekend, I want to know what you're planning to do. Any more light switches need changing in your house?
Honestly, I'm going to sound so bored. I'm actually not doing that much at all. I'm going to a family doing sunny Hartlepool, which will be fun.
Well, he's doing nothing. So if you need a light switch fixing in your bathroom, just write it. We'll send him round.
He's the only guy who seriously, pensions seem more interesting than your life.
I know. I am normally more interested. It's just this week that I'm not, unfortunately.
Yeah, we chose to invite you on in the most boring week of your life. Anyway, it's good to enjoy Hartlepool.
Yeah.
Jenny, any rules you're going to be breaking this weekend?
Well, Greg said I wasn't allowed to book any more holidays, but I've seen a really good deal on TP Rewards for cashbacks, and I've got a week to spare holiday-wise, so I'm thinking, because he's actually going to do a run, cycle, bike ride, whatever, or something like that. So he's actually not going to be in Sunday morning. So as long as he doesn't watch this beforehand, and I get away with it, get a nice bit of TP reward cashback. And
I like what you've done
book
there.
a holiday.
You've revealed something about yourself and plugged the rewards at the same time.
Exactly,
I like it. Yeah. Very experienced podcaster. Steve?
Yeah, I knew it'd come to me. I've got a fantastic weekend, actually. You'll all be envious of this. My wife's away.
Yeah.
Right.
So you're booking a holiday as well?
No. She's actually on holiday.
She's
If she goes on holiday without me now, that's the state of life we're at. I'm actually starting my dahlias off. Yeah, anyway, what I'm going to do
I
is...
won't put you down as a gardener.
Yeah, well, she gave me this task before she went 10 days ago, and she's back on Sunday, so I better do them. So yeah, I'm going to start them off in pots, the tubers, and I'll put them in the vestibule where it's got a heated floor, so they'll...
All right, Steve, that's enough. Thanks very much. Can't take any more excitement from you, but enjoy your Green Shoots weekend. Thank you very much for watching. I hope that's been useful. Do hit that subscribe button, because if you do that, you'll find out more about what Tom does on a weekend or doesn't. You'll find out more about Steve's green shoots in his garden. And of course, more importantly than that, you'll never miss another beat on Morning Market. You'll know exactly what's going on, and you can tune into our podcasts. They'll just come straight to you as easy as that. So do hit that subscribe button. But for now, thanks for watching. We'll see you next time.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.